Hello, everyone. This is Kiran Rohra, your local Bay Area Realtor in San Jose. So we are bringing you these seminars on real estate. And today I have here a guest. So Jason Wiedlin.
Hi, everybody. Jason Wiedlin with Prosperity Home Mortgage. Nice to meet you all.
Okay, and thanks for joining us. And we are very pleased because you are here. Our topic today is going to be all about home loans. So let's go to the next slide. We have 3 items that we thought would be of interest to our buyers out there. So we want to talk about the home loan and the home buying process. How does that fit in? Then we want to talk about what are the key aspects considered in the home loan application. So you as a mortgage consultant can actually advise our buyers out there. And then we will talk about, or Jason will present, a selection of home loan programs. Okay?
Yes.
All right. So let's go right into our very first part of the agenda is basically the home loan and the mortgage process. And Jason, please go ahead.
So here we've got a basic roadmap of the process that'll take place. So you and your loan officer are going to be kind of married for 30 days while you go through this. So we start off with pre-qualification. So I like to understand some elements of everyone's situation, what's their income, what's their assets, and I would present different loan programs to the person. We'd get an understanding of what the whole loan situation looks like, your total payments, your total cash to close. And if we're all on the same page at that point, that's where we push it to the next step, which would be the actual pre-approval. So step 1, we collect assumptions. Step 2, we'll take it to the next level. We'll pull credits. We will collect some documents to back up the assumptions that we programmed into the first step. And we'll issue a pre-approval. Now you could go out, make offers on properties, get into contract on different properties, and we feel confident at that stage with the credit reports and with the documents that we can perform on the loan there. This is also the stage where your offer would be accepted by a seller, and your real estate professional works with you to write that offer to your specifications. And once it's accepted, we'll have the back office step in and kind of double check the documents, the whole loan, to make sure it all comes together. And that includes things like an appraisal and other conditions that we can't necessarily verify ahead of time. So once we have everything together, all those documents have been signed off, we've got the appraisal in, we've got insurance in place, we'll issue your final loan approval. So that means we've dotted all the I's, we've crossed all the T's, and now we're ready to start moving into the closing phase. So we'll issue a closing disclosure. Initially, we're giving you some estimates on how things are going to look. By the time you get the closing disclosure, we've got it pretty much down to the penny on how that transaction is going to close there. So you'll feel very comfortable with how that transaction looks at least 3 days before you sign and are responsible for that with the notary. Step 6, that's your closing. That's always a happy stage. So you'll get your keys at that point. A title company or title agent will move that title into your name. They'll send the funds to the seller, and now you are a homeowner. And step 7 happens after the fact. So initially, the company that started off your mortgage, they only service it for a short amount of time before they transfer it to another servicer, typically. So we've got a great roadmap PDF of this process. So you can reach out to either Kiran or myself, and we can forward these details to you too, and really talk about your own situation in more detail.
Okay. So there's a lot going on there, which I think is really helpful for our buyers out there to understand. And especially, I'm glad you talked about the very first thing is the pre-qualification, because we do have let's say our buyers, our home buyers, and they are very, very early, and mostly they're saying they're just looking. But they really wouldn't know until they're pre-qualified what would be their purchasing power.
Yeah.
So, and actually, it could be even higher than what they're thinking. And that really gives them a better start on visiting open houses or seeing homes with the agent once you do have that pre-approval in the hand.
Yeah, and there's a lot of anxiety I see about people to start that process there.
Mm-hmm.
I really want to emphasize the first step is just us talking, understanding your situation. Personally, I don't pull credit until we've had that conversation. I kind of propose what this loan is going to look like, get that comfort from the buyer, and then we talk about pulling credit. So the first step is really getting you comfortable and kind of lining up your situation with your ideal loan there. So it's no cost, no pressure, just giving you more information at that first step.
Okay. We do have a hand raised, but yeah, let's see if there's a question on this slide. So we have Jagan here on the call. In fact, he's part of our team. So, Mr. Jagan, is there anything you'd like to add to this discussion?
Yes, I want to ask only one question from. Is it okay?
Yes, I'm not sure. Maybe we'll come back to you. Just check on the audio side there, Mr. Jagan. Okay, so let's go to our next item that we talked about. And I will kind of minimize the video here. Yeah, so there's, you've called it the 5 C's of credit liability. So Jason, how do we look at this? How do we understand this?
Yeah, so one of the steps we talked about, both pre-approval and also the back office verifying the application. There's some general guidelines we go by. So we call it the 5 C's of credit. It's the different elements of your application that we look to understand. And for each of the people applying with me, I'll write out notes on each of these areas so we can kind of describe how the borrower is going to function.
Okay.
And it's just kind of shorthand to really understand the situation at a glance there. So your credit history is part of it, your credit score, your liabilities, your history of paying on time taken into consideration, capacity. We really want to make sure people have the ability to repay this loan. So we'll look at their income and liabilities, including the new home purchase, and make sure that this is a reasonable purchase. We're not going to put undue burden on them for this. So we'll establish that as well. Capital. So we're not just talking about do you have enough cash for your down payment? We also want to make sure that there's sufficient funds for other closing costs you might have. We'll take a look at what's left afterwards. We don't want someone to purchase without any means to pay for other things afterwards. So we call that reserves or post-close liquidity. And we'll look at liabilities. If there's some debt owed, we've probably taken that into consideration for capacity, ability to repay, but we also look at savings versus what's owed there to show a history of savings.
Okay.
Collateral, if we're talking about a mortgage, would typically be the home you're purchasing.
Right.
If you don't repay the loan, that's the lender has the recourse of possessing that property afterwards. So we'll go into some detail about the collateral and considerations for that. And lastly, conditions. Sometimes we are in a tighter credit market where lending standards might be tougher than normal, and other times, things are booming, stock market's going up, wages are going up, conditions might be a little looser there. So there can be some external factors or some other things that we would write about there.
Okay. So I just want to pick up at least one question that comes to my mind. You're talking about the debt to income ratio, right? So many of us have other loans before we even sign up for a home loan. We could be having a very typical is a car loan. So how do you look at that, and what does it mean for the buyer?
Yeah, great question. So if you're purchasing a home, that represents a certain expense. But if you have some existing obligations like a car loan, we'd stack those on top of each other to view your total debt to income ratio. And one of the things that we'll do at the early planning stages is explore maybe how we can restructure the application to make sure that you're getting the ideal loan scenario. So I'm working with a buyer right now. We weren't quite getting their purchase price they wanted, but we realized by decreasing their down payment a little bit and having them pay off a car loan, we were really able to expand their purchasing power and get them to where they wanted to be.
Okay.
So the payoff could occur after the offer is accepted. So we could really get creative with structuring the best situation for everyone.
Okay, very helpful. Okay, great. Let's go to if you have an overview for us on at least a selection of home loan programs that Prosperity is offering. So if you can kind of a little bit go over the slide for us.
Yeah, so we break down loan programs into 3 different categories. Conforming loans, that's where Fannie Mae, Freddie Mac loans, very vanilla type loans. So a lot, I think at last I checked, 76% of the loans in this country are in that first category, conforming. They do have a loan limit. So we are in Santa Clara County, a high cost of living area. So that has a loan limit of $1,089,300. So that might be a limiter while we would work there. And pretty low down payment options here, and pretty standard options. There's also a government category. So if you've heard of an FHA loan,
yes,
that's a government loan. So it's a government-backed mortgage. Same thing for VA, and USDA is for rural properties. So, so these are similar to conforming, but depending on people's situation, it may be advantageous to go with that category. A VA loan lets you do 0% down, which could be nice, and FHA can be more flexible with certain lending areas. So maybe people would qualify for more than one. We discussed the benefits and advantages of working with each. Last category is jumbo or non-conforming. So a lot of times the banks will make their own rules outside of Fannie Mae, Freddie Mac standards. And a lot of times they're called jumbo because they usually start just above the conforming loan limit. So $726,201 right now. Typically higher down payments. We used to see a lot more 10% down jumbo. It's a little harder to come by now, but there's still some options out there. So you might expect 10, 20, or 30% down for these kind of programs. And there are really dozens of different options for jumbo or non-conforming, maybe probably hundreds. So the rules could vary from different ones. So there's a lot of different originators for that category. You as the borrower don't need to understand all of these, and you don't need to ask your loan officer which one you want to do. A good loan officer is going to understand your situation, propose multiple options, talk about the benefits and advantages of these different programs, and let you pick what's going to work best for you.
Okay, and then that's I'm glad you said that. That was my question, because these are some programs, there could be others, and things change, I believe, constantly. So it's very, very difficult for a buyer, especially the first-time home buyers, or even otherwise, to know what is right for them. And that's where that step 1 comes in of the process. Talk to the mortgage consultant as early as possible in the process, and start looking at what is a good fit for you, because he or she can advise you accordingly. Right. The other thing I do want to remark, I have said it so often also to my buyers, most buyers think they need to put 20% down. And when they don't have the 20% of whatever purchase price they're thinking, they just keep waiting to save that. And, the kind of the time window is moving out for them. So I'm glad you included that on the slide. that really there could be very, very different programs, and something could work for someone or something else could work for them better.
Yeah, great point. I run into that misconception a lot, that 20% down is needed. That's a great number to strive towards, but the reality is most first-time home buyers are much less than 20% down. It's a nice number because you could avoid a mortgage insurance, PMI, by hitting 20% down with conforming loans.
Yeah.
But I think in a lot of cases it makes sense to get in sooner, get that home, and build your equity through regular payments and appreciation, rather than just wait for that 20% down payment.
Okay. So I'm hearing a lot of things which we do want to cover in follow-up seminar, further details and further information. And we're making notes of that. So we'll bring you that information in let's say in the coming weeks. But I think we are moving to close this session of ours. I do want to put you on the spot and ask you one question, but probably two actually. One, I think, is a simpler one. What is the current interest rate for home loans?
Yeah, just this week it hit 7.49% for a national average. So we're hitting some highs we haven't seen in over 20 years. So yeah, about 7.49.
And now the second is the trickier question, and let's see what you can tell us. What is the outlook now?
I get that one a lot. Yeah. Hard to say what direction it's going to go. In general, I think it may be 0.5% higher, 0.5% lower by the end of the year. Really hard to say where we would go now. I'm not expecting any dramatic change one way or another, although it could go more than that.
Yeah.
So my advice is always, if you could make it happen now, that's your best option. And as there's no strong prediction that things are going to be lower anytime soon.
And with that quick addition that if they do go down, the buyers who have purchased already obviously have a chance to refinance.
Absolutely. Yeah. No sense in waiting for the rates to go down. We can always refinance. Yes.
Sounds good. Thank you. All right. So this is really our last slide. We are happy to bring you informational seminars every week. And sometimes they're really busy on Saturday morning with our open houses. So like today we did Friday, but we could alternate, and we'll keep you updated through our social media. And this is also on our YouTube channel. You can find that very easily, or give me a call, send me a message or an email. And do join us next time, and we'd love to get your questions too. With that, Jason, thank you very much for joining us today and for all the information you shared on all about home loans.
My pleasure, Kiran. Thanks so much for having me.
Okay, thanks everyone. Bye-bye.